By 9 in the morning, the sidewalks on Auburn Avenue were already packed. Men in three-piece suits moved between storefronts that carried their own names above the door. Insurance offices, printing houses, pharmacies, a funeral home that also financed mortgages, a bank with a marble lobby that processed more deposits in a single week than most rural counties saw in a year. The buildings were brick, not wood. The glass was a plate, not salvage. And on this one street, in one city, in the American South, Black men and women had built something that should not have existed by any measure of what this country had permitted them to have. Forbes would not use the phrase until 1956, but Black newspapers had been circulating the sentiment for decades before that. Auburn Avenue was called the richest Negro street in the world. And that was not poetry. It was an economic assessment. By the 1920s, Atlanta's Black business class controlled millions of dollars in real estate. They operated multiple financial institutions. They ran insurance companies with policyholders stretching across the entire Southeast. They employed Black professionals in law, medicine, and education, and they built private residences that rivaled the estates of white industrialists on the other side of town. All of this existed inside a legal and social architecture that was specifically designed to prevent exactly what they had accomplished. Within 2 generations, most of it would be gone. Not burned in a single night, not stolen in one dramatic event. It was dismantled, piece by piece, through instruments of law and policy that left no mob on record, no arsonist to prosecute, and no single moment you could point to and say, this is where it ended. The collapse of Black Atlanta was not a catastrophe. It was a process. And understanding that process means going back to the moment when the wealth was real, the institutions were functioning, and the threat had not yet arrived. Alonzo Herndon was born into slavery in Walton County, Georgia, in 1858. His mother was enslaved. His father was the white man who owned her. When emancipation came, Herndon had nothing. No land, no education, no inheritance. What he had was a razor, a steady hand, and an understanding that providing a personal service to white clientele in the postbellum South was one of the few economic lanes a Black man could occupy without triggering immediate suppression. He was not wrong. By 1878, Herndon was cutting hair in Atlanta. By 1882, he owned his own shop. By the turn of the century, he was running 3 barbershops, including a Crystal Palace establishment on Peachtree Street that was considered one of the finest grooming salons in the entire South. His white clients were senators, businessmen, and professionals. They sat in his chairs. They paid his prices. And through that simple transaction, capital moved from the white economy directly into Herndon's hands, where it was immediately redirected. In 1905, Herndon purchased the Atlanta Mutual Aid Association for $140. The company was barely surviving. He restructured it, capitalized it, and renamed it Atlanta Life Insurance Company. Within a decade, Atlanta Life was processing thousands of policies across multiple states. By the time of Herndon's death in 1927, the company held more than $1 million in assets. It was the largest Black-owned insurance company in the United States, and one of the most significant Black financial institutions in the country by any measure. But Herndon did not stop there. He bought real estate across Atlanta. He invested heavily in Auburn Avenue properties, and he built a Beaux-Arts mansion in the Vine City neighborhood, completed in 1910, constructed entirely by Black craftsmen, furnished to European standards. 9 rooms, formal gardens, Ionic columns carved from Georgia marble, fireplaces in nearly every room framed in original tile and woodwork. This was not a house built on aspiration. This was a house built on arrival. A former enslaved man standing in a marble foyer that he paid for with capital, he accumulated 1 haircut, 1 insurance policy, 1 real estate deal at a time. That mansion still stands today, preserved as a National Historic Landmark, and walking through it still feels less like touring a museum and more like stepping into the origin story of Black economic power in Atlanta. And Herndon was not alone. John Wesley Dobbs was not a businessman in the same mold, but his influence on the political infrastructure behind Black Atlanta's economic success was foundational. Dobbs was a Mason, a railway mail clerk, and a civic organizer with extraordinary reach. He served as Grand Master of the Prince Hall Masons of Georgia for more than 2 decades, starting in 1932, and through that network, he built a base of registered Black voters during an era when registering to vote in Georgia meant navigating poll taxes, literacy tests, white primary exclusions, and the constant threat of economic punishment for showing up at the ballot box. Dobbs understood something critical. Economic power without political power is always temporary. He gave Auburn Avenue its famous nickname, Sweet Auburn, because the name captured the emotional truth of what that street meant to a community locked out of nearly every other civic avenue in the country. At its peak, the financial architecture of Sweet Auburn was extraordinary. The corridor housed Black-owned banks, including Citizens Trust Company, which was chartered in 1921 and became one of the oldest continuously operating Black-owned banks in the nation. It housed the Atlanta Daily World, one of the most important Black newspapers in the South. It housed the Royal Peacock and other entertainment venues. And it housed the offices of Black physicians, dentists, and attorneys who had been barred from practicing inside white institutions and so built their own from the ground up. That concentration was not accidental, and it was not just community preference. It was a product of exclusion. Every door that closed to Black professionals in white Atlanta pushed them toward Auburn Avenue. And over time, that forced concentration produced something powerful: density of capital, density of talent, and density of institutional memory. The barber knew the banker knew the attorney knew the insurance executive, and all of them lived within walking distance of each other, spent money in each other's establishments, and reinvested in the same corridor that sustained them. The capital did not leave. It circulated, it compounded. And for a community that had been deliberately locked out of every mainstream financial system in the country, that closed loop of economic activity was not just convenient. It was survival infrastructure. So that was the condition. Constrained, absolutely. Operating inside a rigid racial caste system, without question. But within those constraints, a Black economic elite had formed, had built, and had begun to accumulate the kind of wealth that compounds across generations. The only question was whether that accumulation would be allowed to continue. The answer came in September of 1906. Atlanta's white newspapers ran a string of reports claiming that Black men had assaulted white women across the city. The Atlanta Evening News and the Atlanta Journal both amplified the stories aggressively. Later investigations would reveal that most of the allegations were either fabricated or wildly exaggerated. But by the evening of September 22nd, facts no longer mattered. White mobs numbering in the thousands tore through Atlanta's streets for 4 days. They targeted Black neighborhoods. They smashed storefronts. They dragged Black men from streetcars. On Decatur Street and Marietta Street, in the heart of the Black commercial district, businesses were destroyed. Residents who tried to defend themselves or their property were killed. Most historians place the death toll between 25 and 40 Black residents, though some accounts suggest it was higher. Hundreds more were wounded. Property damage reached into the hundreds of thousands. But here is the fact that history often skips past. The Atlanta Race Massacre of 1906 did not destroy Black Atlanta's economic class. The massacre was devastating. It was traumatic. It reshaped the geography of racial tension in ways that lingered for generations. But the institutions did not collapse. Herndon's businesses endured. The community rebuilt. The elite did not flee. They stayed and they rebuilt. The violence failed to eliminate what exclusion had accidentally concentrated. And for a brief window, it looked like the economic engine of Sweet Auburn might be too resilient to stop. Then the Depression hit. When it did, The structural vulnerabilities that had always been buried beneath Black Atlanta's success were suddenly exposed. The National Negro Business League had counted more than 100 Black-owned banks in the United States at the start of the 1920s. By 1936, fewer than a dozen were still standing. That collapse was not just about the Depression itself. It was about the Depression hitting institutions that had been deliberately excluded from the correspondent banking networks, the federal deposit systems, and the credit pipelines that white-owned banks used to survive economic contractions. White banks had access to federal lifelines. They had relationships with larger institutions that could extend emergency credit. They had seats at the table where recovery policy was being written. Black banks had none of that. They were operating in the same storm, but without the same shelter. And when the winds hit, they went down first, and they went down hardest. In Atlanta, Citizens Trust survived, but it was one of the rare exceptions. Black depositors who had placed their life savings in Black-owned banks that went under lost those savings entirely. There was no federal deposit insurance until 1933, and even after it arrived, the benefits were distributed unevenly across an industry that was racially divided from top to bottom. A Black family in Atlanta who had spent 15 years saving for a home, depositing a few dollars at a time into a Black-owned bank that their community had built from scratch, could wake up one morning and find every cent gone. No reimbursement, no appeals process, no recovery plan, just gone. The credit that Black businesses needed to weather the storm simply did not exist. White banks would not lend to them, and many of the Black banks that might have helped no longer existed. By the mid-1930s, Sweet Auburn was still functioning. Atlanta Life was still operating. Citizens Trust was still open. But the depth of the financial infrastructure had been significantly hollowed out. What had once been a layered system of institutions was now thinner, more exposed, and running with almost no margin for error. And then came redlining. In 1933, the federal government created the Homeowners Loan Corporation, and by 1935, that agency had begun producing color-coded maps of American cities. Maps that graded neighborhoods by supposed lending risk. Green meant safe, blue meant still desirable, yellow meant declining, and red meant hazardous. In Atlanta, as in virtually every city where these maps were drawn, the red zones overlapped almost perfectly with Black neighborhoods. Sweet Auburn, Vine City, the West Side communities where Black professionals had built homes and raised families for decades. All of it colored red. And that red line did not just sit on a map, it became a wall. Banks used those designations to justify denying mortgages to Black applicants. Insurance companies used them to inflate premiums or to refuse coverage entirely. The federal government itself, through the Federal Housing Administration, underwrote loans in green and blue neighborhoods while systematically excluding red ones. The same Black families who had survived the massacre and weathered the Depression were now being told by the federal government that the neighborhoods they had built were officially worthless. Not because the homes were falling apart, not because the businesses were failing, but because the people living there were Black. Redlining did not just freeze Black wealth in place, it actively drained it. Property values in redlined neighborhoods could not appreciate at the same rate because the lending market had been artificially choked. Black homeowners could not refinance. Black entrepreneurs could not leverage their property for business capital. And the gap between Black and white wealth, which had been narrowing through decades of institution building on streets like Auburn Avenue, began to widen again. Not because of any failure of effort, but because the rules of the game had been rewritten at the federal level. And then the maps were drawn again. Different maps this time. Highway maps. After World War II, American cities entered a period that planners and politicians called urban renewal. The federal government made billions available for cities to redevelop what were classified as blighted areas. And the definition of blight in practice was almost always synonymous with the presence of Black residents and Black-owned property. Atlanta was no exception. The construction of the interstate highway system became the single most physically destructive force ever applied to Black neighborhoods in the city's history. Interstate 75 and 85 were routed through Atlanta beginning in the 1950s, with construction extending deep into the 1960s. Those routing decisions were not driven by geography alone. The corridors were drawn through communities that were politically underrepresented, financially unable to mount legal challenges, and racially segregated in ways that made their displacement invisible to the constituencies that actually held power. The downtown connector, where 75 and 85 merged through the center of the city, cut directly through neighborhoods with significant Black residential and commercial populations. Homes were demolished. Businesses were seized through eminent domain. Property owners who had spent decades building equity received compensation set by government assessors, not by the market. In a housing landscape where racial discrimination meant equivalent properties in other neighborhoods were either completely unavailable to Black buyers or priced at a premium that reflected the constriction of the Black housing supply. Those payouts fell well below what it actually cost to start over. Think about what that means in practical terms. A Black family owns a home they purchased in 1935. They have been paying it off for 20 years. They have raised children in it. They have maintained it, improved it, built a life around it. Then a letter arrives from the city telling them that their home sits in the path of a new interstate highway and will be demolished. The government offers them a price based on its own appraisal, a number that does not reflect what the home is worth to the family, and does not account for the fact that finding a comparable home in a market rigged against Black buyers will cost significantly more. They have no political leverage to challenge the decision. The highway gets built, the family gets displaced, and the wealth they spent 2 decades accumulating evaporates in a single transaction they never agreed to. Multiply that by tens of thousands. That is how many Atlanta residents were displaced across the post-war decades through a combination of highway construction, public housing demolition, and institutional expansion. The Sweet Auburn corridor itself was not physically bulldozed by the highways, but the residential density that had fed its commercial life was gutted. The customers who had walked those sidewalks, patronized those shops, and deposited their paychecks at those banks were scattered to other parts of the city, to suburbs where the commercial infrastructure never followed. The mobs destroyed storefronts. The highways destroyed foundations. And the legal mechanisms that made all of it possible were designed to look neutral. Eminent domain applies to every property owner. Blight designations follow criteria that never explicitly mention race. Highway routes are approved by engineers who can point to traffic flow analyses and cost projections. But the pattern of outcomes told a completely different story. Across Atlanta, across Birmingham, across Nashville, and across every major American city where this process played out, the neighborhoods classified as blighted, the corridors chosen for highway construction, and the communities whose displacement was treated as an acceptable cost of modernization were overwhelmingly Black, and the communities being dismantled had no political voice to fight back. Despite decades of voter registration work by people like John Wesley Dobbs, Black Georgians faced systematic exclusion from the political process well into the 1960s. The white primary was not ruled unconstitutional until 1944. Poll taxes persisted. Registration barriers persisted. Organized voter intimidation persisted. The people being dispossessed could not challenge the zoning boards, the highway planners, or the banking regulators who were methodically reducing their economic position, because they had no effective representation inside the institutions doing the dispossessing. Citizens' trust survived. Atlanta life survived. The Herndon Mansion still stands on University Place in Vine City, preserved now as a museum and a National Historic Landmark. These survivors matter. They are evidence of extraordinary institutional resilience under extraordinary institutional pressure. But Auburn Avenue is no longer the economic center of Black Atlanta. The pharmacies and the banks and the insurance offices and the printing houses that once made it function as a self-contained economic ecosystem are gone. The street still exists. Many of the buildings still stand. What no longer exists is the density of Black economic activity that once gave those buildings meaning, and that absence is not the result of any single event. It is the accumulated weight of a massacre that failed to finish the job, a depression that hollowed out the financial support structures, redlining policies that choked off access to credit, urban renewal programs that scattered the customer base, and highways that physically reorganized an entire city around their exclusion. Atlanta did not lose its Black elite in a single night. It lost them one zoning decision, one loan denial, one highway interchange at a time. And the darkest part of the story is that every single instrument used to make it happen was written on official letterhead, approved by a committee, and filed in a cabinet somewhere as progress. If this story opened your eyes to the real forces behind the rise and fall of Black wealth in America, make sure you like this video, subscribe to the channel, and share it with someone who needs to hear it. We are building something here, and your support keeps this research going. We will see you in the next one.